His point was, it was a good talking point. I really didn't have a lot of answers for him, because if we talk about valuations for startups, I'm a lot more geared towards software, and I'm going to tell you, your Series A would be at this. And he's like, how do you, if I'm doing a $5 million raise, what is a fair valuation for hardware? What are the differences that you guys see between valuations in a hardware startup and a software startup? Because a hardware is so much more capital intensive, right? And usually they're going to have to raise more money. But do the valuations in terms of how much equity a founder is selling in a company, do they stay about the same? Or, can you guys provide any color there on the differences between the two?
Yeah.
You want to go first?
Sure.
and then I'll give the right answer.
Absolutely. So software businesses, as you know, especially if they have a recurring piece of the revenue stream, these businesses are very highly scalable once they kind of get traction. Before they achieve cash flow break even, there's a lot of upfront investment that goes into these companies as well. But they're also very profitable at the end of the day. And these days, what we see is a lot of these software companies are being valued as a revenue multiple, ARR, or some form fashion of that. We invested in I shouldn't be calling it a hardware. It's an IoT business, which has a combination of hardware and software, right? So what we do is, I think valuation, let's take a step back. We always look at it as more like an art than science. We always ask what a valuation guidance is. And we, especially in the inner ears, is what we want to base our valuation off of, not 5 years, 10 years down. So it's very important. The way we look at it is current run rate, what the revenue is, and put a particular multiple to it. Now, multiples could vary from company to company. Otherwise, all the companies would have the same valuation. So again, there's a lot of art that goes into it. The quality of the management team, it's like a scorecard methodology, right? The total addressable market that these guys are approaching, the technology moat, the robustness of the sales pipeline. If a company is saying, and from T equal to 0 till T equal to 12 months, I'm going to go from 1 million to 5 million. What is the basis of that, right? We dig deeper into the sales pipeline, make customer calls, and see through our experiences of being involved with startups and running P&Ls, we see how feasible that is, in the current macro. Now, if the companies have multiple end markets, that scalability is much easier. Versus if they're just focused on one end market. But then again, there's a trade-off between going too broad and being very focused. We are on the side of being very laser focused. But if the companies already have customers on the other end markets, it gives us more confidence in putting a premium to their valuation. So again, there's no right or wrong answer. It's more artsy than science.
Yeah, absolutely.
So as to complement a slightly different perspective on that, I think there's a few different things in terms of from a valuation perspective. You're absolutely correct, traditionally speaking, and I'll take some examples outside our industry. So if you go and look at pharma companies, any biotech company, and you look at their Series A or Series B, what do you think their total capital raise is? Give me a number.
100 million.
Exactly. Because that's what it takes.
That's what it takes. Yeah.
That's what it takes. I mean, when you look at a Series A or Series B of a biotech company or a pharma company or a startup in that healthcare space, they raise a 50 million Series A, 70 million Series A, 100 million Series A, and energy, 5 million. I mean, the number you mentioned right now, Collin, is $5 million for the CSP business. So I think you have to look at what will it take for a company to get to the next milestone. Now, coming back to your valuation question, you're absolutely correct. Hardware typically takes more capital in energy. And market adoption is longer. So when you're going in there, you have to make an assessment of saying, how mature is this technology? Is this thing really sussed out? Or is this an idea or concept on paper? And that's why that minimum viable product and those, if you want, not customers who are pilots, but commercial customers are very important. That's why that's something that we look at, because that time to market adoption in energy and even in clean tech is much longer in the B2B space than in the B2C space. The other aspect to look at is, and Abhinav is correct, there's no black and white answer on valuations, is to say, okay, it's a judgment call to say how big of a problem are you solving? how big of a market are you going to get to, and what is the potential of this technology to scale as a product. Now, all of those factors come in. We all know software multiples and valuations are higher than hardware. And one of the reasons you can do that is because once you've developed a software product, whether you sell 1 license or 100 licenses, the incremental cost is minimal. From an SG&A perspective, it's your sales channel.
Yeah.
It's a little bit in terms of making, for lack of a better word, and today, in the old days, in logging days, you used to get a little CD-ROM to upload your latest logging software. Well, now you just log it down online, right? You just download it.
Yeah.
So the cost of service delivery or the cost of the product is minimal. And therefore, the multiples are much higher.
Yeah, with software, you can scale without scaling up your G&A as well.
Absolutely.
So
I think one more point to mention here is, the industry as a whole becomes very obsessive with valuation, but what is equally important, if not more, is the terms that go into it, right? Minority protection, right? Governance terms, liquidation preferences, dividends. All these are also, kind of important. So we look at things in totality rather than just a valuation perspective.
yeah, you have, like in this case, a first-time founder. His attorneys are building out a term sheet, and he doesn't want to scare off any investors with a valuation that's outlandish, right? And all of these things are negotiated, but he doesn't want to just come, swinging and say, oh, my company's worth $100 million. And so I told him, I said, look, for Digital Wildcatters, we triangulated our valuation. We first, me and Jake came up with what we thought it was worth. We talked to one of our investors, asked him what he thought it was worth.
The important thing about that was we did it separately, and then we came back together.
Yeah.
And
which is very good.
Showed our numbers, and it happened to be the exact same.
Yeah.
So
and then same thing from one of our investors, and then I got a comp, and I saw what their seed round was, and boom, we had 3 points of references to where we could come to our valuation. And that's one thing I told him to do. And then also, if anyone's listening, I also recommended that he reads the book Venture Deals. It's a great book. Abhinav just brought up a great point. The terms that go into the term sheet of the deal are important, right? When you're talking about liquidation preferences and all those things. I spent 10 hours this weekend reading Venture Deals, just going over our term sheet. So
it's a great book.
Yeah, it's a great book, and it'll give founders a lot of insight if you haven't done it before. But yeah, even with, he's talking to me, and I interface with a lot of startups, and I'm like, yeah, I'm not comfortable even giving you a ballpark on what a valuation is. I was like, I know another startup that was half software, half hardware, and, they raised $5 million at a $25 million valuation. I said, I figure if you do a $20 million valuation, no one's going to, tell you that you're just out of your mind. So it's interesting to, hear those nuances between a software and a hardware, and how you kind of reverse engineer what that valuation should be. And you guys do it for a living, right? So
absolutely.
Yeah, you have founders, I'm sure, coming out all the time with just batshit crazy valuations. You'll never get that, but you have to be able to support your reasoning for why, that valuation isn't appropriate.
There has to be a logic to it. When an entrepreneur comes and says, okay, I value my company at $100 million or $50 million pre-money valuation, there has to be a logic or a rationale to it. And as long as they can explain it and get us comfortable. And by the way, if any entrepreneur wants to reach out to us from your audience, happy to sit down with them.
Yeah.
And so this is how we would approach it. This is how we would think about it. And we don't claim to have all the answers.
Yeah.
So we're happy to collaborate. And that's one thing we want to do with entrepreneurs, is really collaborate. And we don't want to, we're not a one-trick pony that's there for 2 years and then disappears, because at the end of the day, you build a reputation, a brand in the market.
Yeah.
And we want to be collaborative and open about it.
I'm really glad you brought up that point, because that's exactly what I told my friend this morning. I said, hey, I can introduce you to a couple of investment groups, and they're more than happy to talk to you and build a lot of founders don't understand this, but when you take capital, it's a business relationship, right?
Absolutely.
And keyword being relationship, and you build those relationships, and you guys are happy to sit down with these companies and develop that relationship, and that allows you to get to know the management team better and understand everything in better context. So
I feel like
it's the same thing we tell our investors. If you're giving us capital in our fund, this is a 10-year relationship.
Yeah.
It's a partnership. So we want to be good custodians of your capital. It's the same way with entrepreneurs. If you invest in a company, we're telling our investors our holding period in these companies is going to be 5 to 7 years. If you go to a website, that's our typical holding period you would expect. So if you're in with someone for 5 to 7 years, you're going to go through some tough times and hopefully some good times.
that's why we're all doing it, right? For the good times.
Tough times are guaranteed.
The bad times make you appreciate the good times, though. So.
I think there's
it's really the tough times that you really find out who your true friends are, who your true partners are.